Hey there, dividend growth stock investors. It's Colby the DGI Crab. Congratulations to you all for getting through the work week. Big time happy Friday to everyone out there. It is the weekend. Maybe for some of you, it's the end of the work week, but maybe for others, this is just the beginning. You might be out there side hustling, working a second job, trying to get some more money to put together to throw into the stock market. Stock market remains on fire for another week, and it doesn't show any signs of slowing down. So you might think that this record that the old crab's playing on here is going to be pretty familiar, but that is just the name of the game when it comes to dividend growth stock investing. You focus in on the things that are undervalued at the time, and that's just where your attention goes. There's always going to be something that's undervalued. There's always going to be things that are overvalued. We're going to try to allocate our money into the things that are undervalued for the best results. Now, I'm not a professional financial advisor, so don't take anything in this video as direct financial advice. I'm not a licensed professional. Do your own due diligence. I am sharing with you my personal strategy of how I build my passive income through dividend growth stocks. So if this is the first time that you are here, the way that my strategy works is I put 50% of my money into age-appropriate ETFs. Stocks that are yielding 30% or more above their 4-year average yield are the ones that I'm putting my new money into. My top 10 favorite stocks, if they're yielding 20% or more above their 4-year average, I do go ahead and invest in those because they're 10 great stocks and they don't get undervalued very often. My goal is to remain within my tier unless there does happen to be a stock in a different tier yielding 50% or more above the 4-year average. And if there's not a buyable stock in your tier, then the way I look at it is that just means put more money into the ETFs. So let's take a look at the tiers. If this is your first time here, I focus on 60 high quality dividend growth stocks, and I've split them into 4 separate tiers based on your age. Tier 1 for the 18 to 30-year-old investors, we are looking at stocks that generally are going to be yielding in the low to mid 1%, but that have a dividend growth rate well above 10%, more in the 12-13% range cumulatively. Nike was starting to get back up into that $90 range last week and then started to cool off a little bit, started sliding back down into the low 80s again. Not a problem at all for me. Just means that it remains undervalued a bit longer and I'm going to continue purchasing it. Now we're looking at this valuation tab here. This is how I have these sorted out. So if we've got stocks in the green, they have hit my mark of 30% or more undervalued, or 30% or more above their current yield is above their 4-year average yield. So you'll see here Nordson has gotten back into that green buy zone, currently yielding 1.24%, 4-year average yield of 0.94%, giving me my 31.71% undervalued valuation. So I like Nike and Nordson in this category still. Nordson was getting up into the high 250s last week. I hit the pause button on Nordson, but down in the low 250s, it hit my 30% metric. So going right back in there on Nordson if I'm in that 18 to 30-year-old group. Tier 2 for the 31 to 41-year-old investors. Tier 2s are usually going to be investing in stocks that are yielding in the 2% range, maybe in the 3% range, depending on what the stock is and how undervalued it is at the time. And we're looking for a dividend year-over-year growth rate of about 7 to 9% with this group. Hershey remains the only stock in the tier that is 30% or more undervalued. Target very, very close this week. Just missed it at 29.68% undervalued. This 4-year average dividend yield continued to just tick up. It just went up 1 little basis point from 225 last week to 226 this week. That was enough to take it out of that green zone down into the yellow 20 to 29% undervalued range. Target's still a great deal here, I think, but just I update the 4-year average yield every single Friday before I do this video, and we see very small changes, basis point or two on a lot of these, but I want to have this number be as up to date as possible when making my decisions on what looks undervalued versus what does not. So for this group, Hershey is the main one here, but Target certainly not in a bad spot either. Tier 3, the 42 to 53-year-old investors. This group, we're going to be emphasizing a 3 to 4% starting yield with a 5 to 7% annual dividend growth rate. Hormel and ADM. It's the Hormel Foods and Archer Daniels Midland Company show here. These two have remained in the buy zone, 40% or more undervalued on these two right now. The 4-year average yield on both of these has continued to gradually climb over the past few months while they've been down, but not so much so that they don't still look like good opportunities to me. Now, Pepsi here, this is one of the stocks in my top 10 favorite stocks. Pepsi is getting near that 20% undervalued mark right now, sitting here at 167.97. I really need to get Pepsi just down below 167. And I think that's going to be just about good enough for me to start adding into my Pepsi position, but I am going to be patient. I'm not going to reach just because it's been a while since I've been able to add anything in this tier outside of Hormel and ADM. I'm still going to stick to the metrics here and focus on the ones that are much more undervalued than Pepsi. But keep your eye on Pepsi. If it drops much more, that's definitely going to be of interest to me. Tier 4 for the 54 and older investors, where we're looking to get a starting yield of 5% or more cumulatively. And we don't want to totally throw out the concept of year-over-year dividend growth, but if we can just make that about 3.5%, that's good enough for me just because we're adding higher yield things at this point in time. And these higher yielding individual stocks in this tier haven't had anything that looks like a great value buy for quite a while now. Kind of the same old story with this group. In a higher interest rate environment, I'm actually kind of surprised that these high yielding stocks have been doing so well this year, because with the Fed cutting interest rates, we're not going to be getting as good of a yield on our savings accounts, things like that. CDs, if any of you are invested in those aren't going to be yielding anywhere near as high, or bonds. So I just really figured that this would have been a good year to buy higher yielding stocks, which are riskier. The conventional wisdom might say, like, well, why should I buy a stock that yields 5%, which carries risk with it, when I could get 5% in a CD or in a high yield savings account, and not risk actually losing any capital? Well, now that the interest rates are getting cut and those safe guaranteed 5% yields, 4% yields are probably going to start going away, I would think these stocks are going to continue to go up. So I'm really at a bit of a loss right now trying to decide what I want to do with some of these, because it feels like maybe the time to just go ahead and start buying some of them might be now. But I'm not going to get suckered into that because I'm impatient. I am going to stick to ETFs when I find something like this in a tier where there's just nothing that looks like it is undervalued. ETFs are less inherently risky than individual single stocks. So if nothing's undervalued in the single stocks, we're just going to keep piling money into those ETFs instead. We don't stop investing. We just go with something with broader diversification. Real quick, just take a quick stop by my top 10 favorite stocks. If I could only hold 10 stocks, it would be these. This is the group that I said if any of these hit 20% or more undervalued, I will start buying them. These are found anywhere from tier 1s, 2, or 3. This is not a new group of stocks. I just put this group of 10 on their own tab so I can keep a closer eye on them. You feel free to take a look if you like. But going into the strategy for the week and what that would look like, tier 1, be focusing in on a collection of ETFs that include S&P 500, small caps, some dividend appreciation, and some international. And then so that would be where about half of the money is going. And then the other half of the money, I would just be I would probably go all Nike at this point, but maybe you could also do something like oh, maybe you could say like 40% Nike, right? And then maybe throw like a little 10% at Nordson, because Nordson did get into that buy range right here at the end of the week. That wouldn't look too bad as a strategy. Tier 2, kind of the same grouping of ETFs, but just with a different weighting. I'm going to put more emphasis in Tier 2 on the dividend appreciation, and a little bit less into S&P 500 and small caps. And then Tier 2, I'm going to go 40% of my capital into Hershey, which is what I did this week. I'm a Tier 2er myself. I'm 40. And then 5% went to Target. It was close enough to 30%. I thought it was, it was worth just throwing a little fiver in Target, keep gradually growing that position. And then 5% went into Nike. It remains 50% or more undervalued, so I'm reaching into a different tier to acquire it because the deal still appears to be that good. Tier 3, my ETF emphasis totally shifts into more dividend, higher yielding focused ETFs, so like VYM, SCHD, DHS are some good examples of those. I'm still going to do 5% into my international funds no matter what tier I'm in, and I like VYMI far and away above any of the other international dividend-focused ETFs. Hormel 25%, Archer Daniels Midland 20%, and then even at the 42 to 53-year-old range, I'm still going to reach down and do a 5%er into Nike while it remains at least 50% or more undervalued. And then for the tier 4s, I've got a collection here of 8 ETFs, high yield stocks, high yield bonds, preferred shares, MLP ETF, my 3 favorite covered call ETFs, Devo, JEPI, and SPYI, and my international here at 5%. So this would be the standard allocation, 15% into the high yield stocks and then 5% on the rest. But no good deals as we saw there on the individual stocks in the tier 4. So I'm going to do an ETF double down with the exception of VYMI. So what does that mean? Well, it just means that instead of doing 15% into SPYD this week, I'd be doing 30. Instead of doing 5% into SPYI, I'm doing 10, and so on down the list here. VYMI for my international, I'm still going to keep that religiously at 5%. That's me personally. And so that's why I've got down here, we got a wild card week for this remaining 5% for the 54 and up. You can do whatever you like with it, I suppose. If you've already got a pretty nice amount of dividend income built up and you're not in total accumulation mode at this point, maybe even at this point, you could do 5% into Nike and acquire the lower yield, but still add in something that's going to get you, we would assume, much better dividend appreciation over the long haul. I probably wouldn't do that at 54 or older just because that dividend yield, even if it grows 10 to 12% for the next several years, it's going to take a little while for that to really be substantial for me. So I'd probably just put that extra 5% into one of these up here. Maybe you're partial to Devo, JEPI, or SPYI. Maybe you're more partial to one of those 3 than the other. So maybe you could do, the extra 5% into one of those. PFFA has been performing pretty nicely for preferred shared ETFs. Shout out to Dividend Bull. I actually learned about this one from his channel several months back, and I agreed with his conclusion. It looks like a very nice monthly paying ETF, and getting some exposure to preferred shares is certainly a good idea if you're in this 54 and up age range. So, all right, y'all, that is the strategy for the week. Pretty similar to last week, but that's what it's all about. It's about consistency, staying patient, staying focused, putting your capital to work for you in the areas that look like they're undervalued, and sometimes that might look the same for several months at a time. Don't worry about it. So long as you are putting at least half of your money into ETFs, you're going to have automatic diversification. So even if you feel like your stock portfolio is getting a little bit lopsided, I wouldn't put too much concern into any of that, because the stuff that's undervalued this year is probably going to be overvalued next year, and some of the stuff that's overvalued right now will end up being undervalued next year. It's just how it works year over year. All right, everybody, links to the tiered videos in the description below. Go check out the video according to your age, why I picked the stocks that are in those tiers, and I will see you all next time. Keep investing, everybody, and I hope you have a great weekend.